Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's podcast. I'm really excited to have with us today Arno Castillo, who is the founder and CEO of CrunchDAO. We'll talk about decentralized asset management, data science, the building of portfolios, as well as, of course, Web3 organizations. And Arno's been an entrepreneur and deeply involved in technology. And so we'll talk about his experience and try to understand what kinds of things he's building now. And with that, Arno, welcome to the podcast.
Thank you for having me.
I'm really excited to go through your background in part because you've also been at Lehman and Deutsche in the beginning of your career. Can you talk about, those regrettable choices? How did you end up in finance?
It was not regrettable choices, it was tough, but I really enjoyed it and I learned a lot. So yes, I worked for 10 years in finance and 20 years as an entrepreneur. Finance for me was a way to learn about, what's happening actually I was already focusing on entrepreneurship, and I believe that learning what people do when I want to buy, sell companies, understand about different businesses, a good way, it's either you go to consulting firm or you go to investment banking. I was more inclined to go to investment banking. So I had the chance to go to Lehman Brothers. That was far before the 2008 prime crisis. It was in 92. So basically I was an analyst, and you learn a lot. You do a lot of number crunching. And this is where the crunch from CrunchDAO comes from, because you do a lot of valuation. Back then it was very traditional finance, traditional valuation.
Can I ask what the workflow was like for analyst work in the early 90s? What was the tooling to analyze things? Because I think a lot of where people are today is they'll assume, some Python knowledge or being an octopus on Excel.
Well, so it's interesting because I read recently that if you want to get hired at Goldman Sachs, you need to learn quite a lot of Python. This is the skills you need. Before it was Excel. But actually, I started on Lotus 123. So I think we started to crunch number on something which is like a black screen. And then you had a control F8, and you would go into what they call WYSIWYG, which is what you see is what you get. And then you could kind of format your spreadsheet. So it was even before Excel. We started before Excel, like in 92. It was before.
That's where you started getting your financial skill set. And so you were saying the things you liked about finance is that you got to see how economics work, how businesses are actually made. Is that right?
That's what I thought I was going to get. This is not what I learned, because then you get into, when you're an analyst, you're quite junior in the organization. So you do a lot of number crunching, you do a lot of valuations using the traditional methods of discounted cash flow, comparable company analysis, and all this analysis that you can do. And basically, whenever there is a deal or an IPO or whatever, you need on one side work on the deal, which is the presentation, work on the prospectus if it's an IPO, but also make some valuation. And when you want to present a valuation to a client, you need to value the whole industry and to have an idea of the value of the business you want to acquire or whatever. So this is what basically I've been doing when I was at Lehman Brothers.
How did that progress, your M&A career and then your consulting experiences?
So the first was Lehman Brothers. Then I moved to Deutsche Bank. And I did more or less the same, but I also moved into a team at some point, which was called the CROCI, Cash Flow Return on Capital Investment. And it was a cross-company team which was working on equity analysis and also financial valuation, where the idea was to say, if you want to value a business, we should not look at the PE or EBITDA multiple or whatever. You told me to be technical, so we can be technical, but I don't want to be too technical, though. So what was interesting is to find out that there was a better correlation in understanding the valuation of companies when you look at return on capital invested. It's not just a matter of growing the turnover or growing the EBITDA, but the question is how much investment do you put into this? How much do you grow your balance sheet? Do get more debt, more equity to finance your acquisition, because if you only dilute, shareholders, then you don't necessarily create value. And so in the late 90s, people started to think about, how does a company create value? And so in order to understand it, you need to look on one side, what the assets are being put on the table and what you get as operating profit or EBIT. And you mentioned that I worked also in consulting, because then after I did this work on Crossy, I got really interested in this approach. And I joined a company called Stern Stewart, which invented something they trademarked, which was economic value added, which was this idea, to look at how a company create value and how can you incentivize management so that they are rewarded on the value creation and not the growth of EBITDA by itself, because it's not the right measure.
Can we take a detour here, because I think it's an insightful and interesting topic. So do you think that the concept of economic value added, and I take it that the value in this case is something like enterprise value that's funded by different financing methods and kind of different treatment of the cap table and the balance sheet. Can we talk about DAOs in this context? And just to give a little bit of a preview, you're working on CrunchDAO, and the DAO word in particular sticks out to me as it relates to generating economic value. And in particular, the shape of DAOs and the shape of networks and protocols is slightly different from the shape of well-understood management and corporate governance. Do you see any connections? What does it mean to add value to a DAO or to a network?
There is actually a connection, believe it or not, but in 1999, I wrote a piece saying that you should create value. A company should create value. And so you should measure the value creation with this EVA or Crossy, whatever, and then you should redistribute this value to the stakeholders. And that's the whole idea, is that you can then, reward and incentivize people working in the organization in the way that the fees of the consulting fee that Stan Stewart was getting. There was also an incentivized, because they were like building a stock option on the value that the company would create. So the DAO is the idea that you have many stakeholders involved in the organization. It can be people bringing capital, obviously. It can be data scientists, in our case, who are working in giving us predictions on the financial market. It can be any partner who is helping us in some way in improving the research quality. And we feel like having a token within the DAO, which is only managed by its members, and basically the members are also the token holders, we think that's a great approach for an entity which is very decentralized. We're working with people from 50 countries. We had more than 2,000 data scientists coming to our tournament, 500 PhDs. So we think it's a great way to the idea of sharing the value is that you create value and you share it with all the people who are stakeholders in the DAO.
I totally agree with you. And at the same time, there's lots of challenges. I think the word stakeholder is really interesting. There's something kind of European to the word stakeholder as it relates to corporations and corporate governance. I think in the US, you would just be saying shareholder. Employees and others have very little economic exposure to a success or destruction that a company does. I mean, the company might generate a lot of externalities, and then you would use the legal system to claim that you're a stakeholder. But, it's a much more kind of narrow concept. Whereas this idea of a stakeholder is really interesting because you are starting to blur the responsibility of an organization, especially if it somehow touches public goods or things of that nature, and the actual economic ownership of the entity. So when you get to DAOs, what does it mean to be a stakeholder? Does it just mean that you own a token? In that case, are you owning phantom equity? How do you think about that piece?
We don't like this. You're it's not the way we say it. Basically, in the past, you were an employee. Like I was an employee at Lehman Brothers, and I would get my paycheck and my bonus. And obviously, if I had stock options, it's not worth anything. But that's for another reason. But basically, the employee was having a sure job. You had to be in a specific location, which is the office. Where you had to go every day. And that was the salary approach. And then you have freelancers. Freelancers, they can choose, to work sometimes at the client or remote. They have a fee, but they don't have the security, and they don't know if it's going to last long, and they don't benefit of the the future of the organization they are making their advisory services for. And so we believe that we have the best of both worlds, where we can have people who contribute. They are almost like freelancers. They don't have to work. They have to work whenever they want. Basically, in our cases, they work mainly on the weekends. They can work wherever they want. And I told you we have people from 50 countries. They don't have to go to the office. They choose to work where they are, wherever they want. But they can also, because they are paid with a token, which is just a payment token. So they could just get paid with a token and transform this token in USD if they want. So it's just the payment. But they can also keep the token because they believe the organization will increase in its performance, and they will get rewarded in the future also. So they can have, they can decide, how much they want to have today, or whether they want to hold on to their token and get maybe another value later. We're not selling it obviously like that, for many reasons. The one you mentioned, that you don't want to be equity, but this is the way when you are stakeholders and you have a finite number of tokens. At some point, the value may go up.
The other thing I wanted to open up relating to this is two concepts. And again, going back to economic value added from the perspective of a company that's trying to do more than just grow their top line or their profitability, but kind of make good use of money, create a return on that money, and to do so in a disciplined way. So when things are in the shape of a company, you often have kind of an agency problem, right? Where you've selected management or you've hired in management, and management's job is to create that value. They have control of the company in a way that the average stakeholder or employee or even shareholder, minority shareholder, does not have. And so there are lots of case law and lots of issues around the delegation to somebody who has control and the agency issues with that, and that their incentives might be to have fantastic executive compensation or expensive travel policies or whatever. So they privatize that value. But there are ways to fix it, but that's kind of the fault. In the DAO case, you have, I wouldn't say the opposite, but the flip side, the other side of that coin, which is for many DAO participants, it's things like shirking. It's the tragedy of the commons, like relying on the labor of a select few people to really stand things up without contributing proportionally, but then benefiting from the value change, the value created from the investment that the core team puts together. And I'm kind of wrestling with this concept of like a core development team versus a management team, the agency issues around management and a corporation versus the public goods problems and sort of the tragedy of the commons issues inside of a DAO. How do you see these? Like, what do you think the trade-offs are? Like, are they real? Are there mechanisms that you found that would address these issues?
I think there are many projects who are thinking about, how can you make this happen and make things more transparent and so on. And so the idea is that I don't even like the idea of a core team, as you might put it together, because there could be a team which should be actually decided by the DAO, at some point. So it's difficult, to understand how you can make this happen. But I believe the team of people, anybody in the organization should be almost voted by the DAO members. And this is something very important. I don't know if it should be, every year, every 2 years, every 3 years, who has skills. I mean, you decide what skills you need in the organization, and then people can propose their skills, and then the organization can decide which would be the best. Obviously, you can put some kind of a council in between so that you don't, vote every small decision, micro decisions. There should be total transparency so that people can decide, if it's the right way. And I think this is very important for us. I mean, for example, we do a AMA every month. We have a Discord channel where a lot of people ask questions, and we have to be totally transparent, So because it's like, it doesn't belong to me. It's not just me. It's an organization which, it's a foundation that belongs to basically all the token holders. So they should all be, have the total view of what's happening.
I want to ask you one more question before getting into the substance of what CrunchDAO does, which I think is also fascinating. And that question revolves around sort of what you've been doing for, as you said, the last 20 years, which is to be a founding CEO of several different businesses, two of which have had exits. Can you tell us what is the role of the CEO? What is the role of a business leader? And maybe what have been the lessons in your personal journey from the first time you tried to be a founder, and then over time as you had more experience building companies and taking on that responsibility?
What I can find as the role, as a CEO, and I mean, at the beginning, it was not that easy. You make a lot of mistakes. But I think what is important is you have to be stubborn, but you have to be very flexible. so, so it's like two opposite things. So you need to have to see the direction you're going to, like it's a highway, and you are stubborn because you want to go that direction. But sometimes, you have to find out that maybe you need to pivot, to listen to your customers. You need to listen to your team. And sometimes you need to quickly pivot and be very flexible. So it's like you have to do yoga and be very stiff also in the same time. That's the way I see the role of the CEO. And I think in a startup environment, because I think it's very different than from a big organization. In a startup environment, people that you hire are all very motivated. They all have a lot of responsibilities. You don't need to. You need to help them. It's not like an environment like you don't work the same way you work in investment banking, where you put even if you put a lot of hours, obviously, but it's very different. So I think the role is mainly to have a vision, to stick to it, and not to be too distracted by all the opportunities that can happen, that people are coming to you saying you should do this, you should do that. So you have to be very focused, but still very flexible.
How does that role change or adjust if it's applied to a DAO?
It's the same thing, but you have to listen to the members. So it's not just the team, it's just, even, actually, it's very interesting what you're asking, because 1 month ago, one of the member that has been very vocal on the Discord is saying, hey guys, what you're doing is great. I mean, we're doing tournaments. We'll talk about this a little bit later. But he said you could, instead of just doing tournaments for you could do tournaments for third parties and create competition as a service. And it's very interesting because we had some people, actually some potential customer asking us, hey guys, could you organize a competition for us? Because we're interested in having this framework for us. So this is an example where instead of just, listening to your team, you should listen also to the DAO members, because they can have great ideas also.
So I hear from you the need to have a vision and the need to kind of have backbone so that you're consistent about where the vision leads, and at the same time being very quick to adjust and incorporate information. Your founding experiences, and I would love to open up a little bit of the substance of each one, but there was a company that you started in 2000, another company you started in 2013, and another company you started in 2020. Those are really interesting kind of pivot points for where technology is, and I think require forward-looking visions and insights as to what to build. Can you talk about sort of that aha moment, that original insight in each of these pivot points? Like, where did it come from? Do you have a process by which you identified a business opportunity, especially when it comes to these sort of fairly technical, difficult, innovative markets? And how did you gather enough commitment to say, yeah, let me pull the trigger?
Well, the first one, year 2000, it's the internet hype. So it basically, for those of the people who are listening who know these years, everybody was thinking about, putting an internet business together. Everybody was thinking that the whole economic world was going to switch to internet, like any business. I was even working as a consultant for like a cement company. And they thought they had to talk in their annual report about internet to so that the value doesn't get crashed. I mean, so everybody was thinking about, if you wanted to be an entrepreneur, which I wanted to be an entrepreneur. I was thinking to myself, if I don't do it in year 2000 or 99, basically, as we started thinking about it in 99, I mean, I will never do it. So we just started to think about, what business was going to be disrupted by technology. So the first business I did had nothing to do with finance. It was a photo finishing business by internet. So basically what was happening, there was two disruptions. One, obviously the camera, the roll was getting out and you were getting into the digital camera. And you could also print photos, not on analog devices, analog machinery, but on digital machinery. And you could also send a picture by internet, obviously. So basically the market of, back in the 90s, when you were coming back from vacation, you had to go to your shop, give the roll, and come back 1 hour later or on the next day and get the pictures. And this has been totally disrupted, and obviously it disappeared. This business disappeared to internet, and even now with the mobile, it's even another subject. But we obviously saw that there was a big opportunity. We were able to raise quite quickly, so that helped going into this direction. For the second one, the idea was that I wanted to come back to my knowledge of finance and insurance, which was background I did. I wanted actually at that time do something in finance. Like I had the idea that you had to do something, you could do something great in valuing companies and valuing businesses or stock market using data and machine learning. I had looked into Quantopian, which was a great entrepreneurship business, but I didn't know how to do it. So I started an insurance business. And the idea didn't come from me, actually. I went to see the different big players in the industry, like the AXA in Europe, it's AXA, Allianz generally. I went to see them and talk to them and presented that I had some skills in internet and that I can build whatever they wanted me to build, to see what they wanted to build. And they started to ask me to build something specific, which was one insurance offer online for specific business. And basically, I had the chance to be able to get 3 or 4 insurance company to ask me to do the same. And so I made a comparator. Okay. So it was great because I was able to build a business where I could compare the offers I had, and then I could subscribe because I was broker. This was a great model that I sold to our French leader called April. And that's it.
And was that your major entry into machine learning and trying to apply it in fintech?
So in the insurance business, you have the problem that you have is that you gather a lot of data on your client, and then you try to find out what the risk is, basically. So it's very simple. You do at some point. We started to do machine learning because what you want is to have a good portfolio. So you want to have customers who are insured. They're happy to be insured, but you don't want to have all the worst risk in the country. So you start to look, and basically that's what insurance companies do when they do a pricing. I mean, when they do a pricing, they try to price the different risk, but the pricing is not perfect, and so we try to improve it. And and back in 10 years ago, the way pricing were down, I think it was based on the experience of people especially in the car industry, for example, in the car insurance industry. I mean, people would have seen that the red car has a higher risk than a blue car, and that would just put maybe an increased premium on this red car, whatever it was, for whatever reason it was, And so with machine learning, you can go much deeper and you can find much. And we were able to have a very good risk ratio. This was it's key in the insurance industry. So we started using machine learning with my partner back in this insurance business, which is Jean, and we started CrunchDAO together.
That makes perfect sense how that machine learning thread got woven into Data Crunch and then CrunchDAO, trying to figure out how else you can use kind of that core technology, but in a different setting. Let's talk about exactly what CrunchDAO does and what problem it was built to solve. And then, anything you can share about kind of the architecture of the technology and how people participate.
Yeah, so CrunchDAO today is a weekly competition where data scientists access and obfuscate the data set, which is about finance, but data scientists don't need to have financial expertise. So they access the data set and then can, over the weekend, do their skills, in machine learning and provide a prediction. And so the idea of CrunchDAO is that at the end of the week, we gather these different predictions from different data scientists. And we believe that the ensemble of all these predictions is better than any particular predictions. And this is the idea that was developed, by Francis Galton. It was a guy who wanted to prove that people were not that skilled and could not, figure out the weight of the cow in a small village. And so he came out, he took 1,000 people and asked them, can you, looking from like 100 meters, can you tell me what the weight of this cow is? And basically he was very happy because nobody could figure it out. Nobody had the right answer. But then when you look at the average, maybe it was even the median, when you look at the median of the predictions of all these village people, he realized that they were exactly on the spot by, I think, 2 kilos. And so this is the idea in data science. It's exactly the same thing, is that you have very different skills. You can use very different type of machine learning algorithm or models. And by using like 1,000 people who give different predictions, you are able to eliminate the outliers and to have a very robust prediction. So the idea is that we take these predictions, we make an ensemble, and at the end of the weekend, basically, we have a ranking of the stock market for the next weeks.
Forgive me for using comparisons. It's kind of my crutch in this conversation because I think it's a pretty technical play, right? So just to pull it apart, what I'm hearing is that first off, there's a financial data set, and in that financial data set is a series of publicly traded companies that have likely streams of return over time. And then there is a transformation algorithm that takes that data set and turns it into an alchemical version of the same. And then on the other side, you've got a platform where quants, broadly speaking, but people who are skilled in machine learning are trying to create algorithms that predict performance based off of this underlying data set. And this is run as a competition, and algorithm outcomes are decoded back into something that can be tradable. Those trades are implemented, alpha is generated or destroyed, and then if there's success from the trading, then some of that gets distributed back to the data scientists in the community. Is that right?
Yeah, so thank you. It's even better than my explanation. The only thing I would add is that CrunchDAO is not a hedge fund and that does not trade itself. Okay, he does this for clients. It can be a sovereign fund, it can be an asset manager. So basically, he does it for a client. So CrunchDAO does this tournament, puts this ranking together, and basically sell the ranking. Obviously, you sell the ranking if the ranking is allowing these institutional investors to make money, which means to have a good ranking. Obviously.
Gotcha. Okay. Makes sense. So the business model is an alternative data stream sold to capital markets desks and so on. The reason I was able to get that together quickly is because I met Richard Craib in 2017, I think, when Numerai was just getting off the ground. He spent a long time trying to explain the sort of setup to me, and it took a while to understand like this setup is even possible, like this blueprint even makes any sense, because from an abstract point of view, it can be really confusing. Now, Numerai is definitely a hedge fund, and they use their token for kind of intermediating the data science competition, and as well as a payment instrument and so on. Can you talk about the distinctions in the space? Like, how big is this space? Because not a lot of people in the world can do an AI competition intermediated by tokens that are focused on using machine learning to generate trading signals. What does the space look like, and what's the shape of the competition? Like, do you bump up against each other? Do you compete for the same quants? Is it sort of there's a best practice and everybody works together? Is it that, the obfuscation algorithms and the underlying kind of data science stuff is so different that actually the structure of what people have to do is different? Can you open up some of those topics for us?
Few things on what you're saying. First of all, what is very interesting is that over the last, I think, a year or year and a half, Numerai has showed is a hedge fund, and they have showed very good performance, extremely good performance. So it proved that the model is working very well. The whole idea of having, in that, if you want me to be a little bit more technical, in data science, the problem is that is the prediction that you're getting out of sample, which means like, is it made on data that you've never seen? And the problem with people working in a bank or in an institutions and doing data science because they're running a hedge fund or they're managing some money, whatever. The problem is that the data scientist is working on data, so he sees the data and he has to make modeling without overfitting, which means making sure that the prediction is given would work out of sample when with data that he has never seen. And it's very difficult to do. And so the whole idea of working in tournaments, that was the idea that was put together by Richard Crabb, but also Richard Crabb advised by Marcos Lopez de Prado, who did a book called Advances in Financial Machine Learning. He explained this, that it's much better to have data scientists not working in silos, which is within the bank, but having data scientists working in tournaments with the data that they have not seen. And so this is the very important thing. So they showed, Numerai is showing that it's really performing very well. Now, there's a big difference between Numerai and CrunchDAO, is that Numerai, as you said, is a hedge fund. And so since Numerai is a hedge fund, they cannot have, it would be difficult to have money coming from the hedge fund going to data scientists in tokens. So the token is totally different from the performance of the hedge fund. The token is it's not even a payment mechanism because there's no money flowing from Numerai to the data scientist. There is a token which is listed, and the data scientists have to play in the tournament, and they have to stake some of the NMR token so that they can have a reward. And so the problem is that some data scientists will earn because they are good over time, and probably some or many will also lose some tokens. So that's fine, but it's a mechanism where there is not the performance of the hedge fund which is rewarding the data scientists. What we want to do is that if our signal is good, and we'll have clients who will buy more and more clients who will buy the signal, then this is a payment that is made to CrunchDAO as buying goods and services, and then we can take this part of this to reward the data scientists who contributed to this performance. So it's a very different approach.
It's interesting to see different business models develop against kind of novel solutions to the problem, right? So to the extent that artificial intelligence can create a black hole in the capital markets, there are many different ways to build around that.
The big question in asset management in general, if the solution to having good predictions is to use out-of-sample tournaments, then you would have, other hedge funds, many hedge funds, who will want to have a data set play on a weekly basis. If you looked at a website that you probably know, which is called Kaggle, Kaggle is a website where people can play tournaments, but it's not dedicated to finance. It's very general. You had even Netflix was done a tournament on Kaggle, but you have a biotech company, but you also had several hedge funds who made some tournaments on Kaggle, but it's a tournament which is just happening on, let's say 3 months, or 6 months, and then it's over. What the hedge fund can do is maybe buy one or two because there is a price. So the asset manager or the hedge fund can buy one or two solutions, which is one or two model that was built together. But they don't have this weekly solution, this weekly prediction, which is totally out of sample and which allows them to make an ensemble. And so we believe that on CrunchDAO tomorrow, maybe you'll have 10 or 20 different hedge funds who have their own data set, who will bring the data set because it's, as you said, the data set is financial information, but it's obfuscated. So they can give it to us. We cannot do anything with the data set. It's obfuscated. We play it with data scientists, and the data scientists will give the predictions, which is also obfuscated, giving back to the client who in this case will know exactly what assets belongs to, what belongs to what asset, and then he can trade it on his own. And so the CrunchDAO basically is just selling this tournament. That's the business model.
Yeah. So whereas Numerai is only one side is open, right? So you can have two sides closed. You could have a proprietary fund that has a captive machine learning specialist. And then if you open up one side of that, you can have a captive fund that has 10,000 machine learning specialists competing for the reward. And then you can open up both sides where you have all the funds competing for all the machine learning specialists, and then an intermediation mechanism that sort of rank orders the stuff.
Well, one thing interesting that an asset manager told me one day is that in the financial industry, you have in the hedge fund industry also, you have a lot of teams who have alpha, but you don't have a lot of teams with AUM, which is asset under management. So one thing which is interesting also is that you can have these people who have alpha, so they have an insight on the market. They can bring this insight to CrunchDAO, and we can share it with the asset managers who want to play data set and want to actually feed their model with this alpha from teams who have great skills, but maybe are only managing $1 million, $10 million, or whatever. That could be the alpha, or their strategy could actually be strategies that have the capacity to maybe manage $1 billion or more. So there's a great way to create value for all these teams also who can contribute.
That's super interesting. And I think in some ways terrifying if it works at scale, but let's see. One more question for you around machine learning, and I'm not sufficiently technical to know even what I'm asking, but I've been told that because we have such magic going on with ChatGPT, natural language processing, image recognition, image generation, like that is now at a place which is truly sort of astounding, right? It's sort of human level performance. Whereas for financial markets, you're staring at the random number generator abyss, or you're staring at a complex system whose interactions are non-computable, is so exponentially intertwined and complicated. And the other thing about the financial returns is that they change through time, right? Whereas you can train a vision system to recognize cats or hallucinate cats very precisely because, generally speaking, cats today and cats a year ago are very similar. You've only got to figure out, like, at this particular time of all the cats, is this example of a cat one or not? Whereas with financial markets, you have the time component. And so I was under the impression that this is like one of the biggest challenges, is that machine learning doesn't really work over time, or like it's not about predicting the future. Is that right? Or have there been advances more recently that have kind of chipped away at these failures?
That's really key what you're saying. So you're saying you're not technical, but it's a very technical question. The financial data is not stationary, obviously. If you look in the data before Lehman crisis, you won't see it, so you cannot predict it, obviously. And same with COVID, for example. But there are many situations like that. When interest rates are moving like this year, like 2022, sorry. Well, it's a very different situation than in another year. So that's the big problem in financial information, financial data. And if you want machine learning to work well, you want the data to be stationary. Ideally, you want it to be Gaussian, and returns are not Gaussian. They are fat tail and so on. So there's a lot of work on this, and we actually do share a lot on this because we like to share. We have developed a framework which is called DeCi framework. So where we actually share what we do, because we want people in the industry to be able to challenge us. We want them to be able to tell us, hey, well, guys, what you're doing here is not the best way. And we want to share not only, what we do, but the data set that we use. And we want people to be able to reproduce. It's a way to be able to build on the research. And if you look a little bit actually on LinkedIn, or we had our lead quant, Matteo Manzi, who made two presentations on actually this question that you just raised, that these are two different solutions that we propose, but there are other solutions, like I quoted the book of Marcos Lopez de Prado, there is another solution, and that's the big issue. How do you manage to make the data, the financial data, stationary so that the machine learning is working well without losing the information? So that's the big challenge.
Super interesting. Thank you for indulging me on that question. Arnaud, I really appreciate the time with us today. If our listeners want to learn more about you or about CrunchDAO or contribute to it, where should they go?
We have a Twitter account, CrunchDAO. We're on LinkedIn, obviously, and we have the website, CrunchDAO.com.
Fantastic. Thank you so much for joining us today.
Thank you, Lex. Thank you very much.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.